Hi guys, last day, one of my YouTube fans who's an Indian showed me his revenues of portfolio. I just want to see that his return on investment for the past year was amazing, I'm kind of jealous of him, but to be honest, at this point in time, I'm not going to chase the rally. Today, I'd like to share some ideas about investment in India with you. As we all know that since outbreak of pandemic, everyone's been buzzing about who's gonna replace China's supply chain dominance. And guess who's been making the loudest noise? You got it, India. They seem pretty confident about seizing these opportunities and becoming the global factory. Plus, let's not ignore the fact that India's stock market has been outperforming China's in recent years. That's got many international investors optimistic about India's future and eager to shift their focus to Indian market. But today what I'd like to see is hold your horses. We've also witnessed a series of negative business stories in the past decades that shatter the illusion of India's invisibility. Companies like Xiaomi getting slapped with 4.8 billion fine, Foxconn announcing its exit from a 90.5 billion semiconductor joint venture with India's Vistro Group. Even big players like Amazon, Google, Samsung, and Apple have faced a hefty fine from India.
Oh, no.
Yet, they're still doubling down on the Indian market. And guess what? Despite all the setbacks, foreign capital keeps pouring to India. It's like everyone wants a piece of its raging elephant. India's got its ups and got its downs. And it's all unfolding before our every eyes, much like its ancient civilization, mysteries and hard to pin down. So without further ado, let's delve into a few key aspects of investing in India that you've all been diving to know. Firstly, let's rediscuss the question. Can India really dethrone China and become the world's top manufacturing nation? Second, what makes India such a lucrative target for foreign investments? And the third one, what's the further outlook for the Indian economy and what kind of returns can investors expect? Well, I'm a stock analyst based in China and I'm also trading stocks. My goal is giving investors a different view to look at the Chinese concept stocks. If you don't want to miss the quality stock analyst video, don't forget to follow my channel and turn on the little bell. Now, let's get ready for some eye-opening insights. My friend, let's break it all down and uncover the truth about investing in India. The dream of being a major manufacturing powerhouse. One of the biggest reasons people support investing in India is probably the demographic bonus. According to a series of population studies by the United Nations, in mid to late April 2023, India's population surpassed a whopping 1.41 billion, making it the world's most populous country, surpassing China as the number one. Looking at the population structure, India's population takes the shape of a pyramid, with around 60% of people being below the age of 35. The median age is 28, so you could see India is a pretty young nation. That's why many folks see the population dividend as a big advantage for India. However, some experts think this prediction might be too optimistic. Having a population dividend doesn't automatically mean more people will translate into economic development. It also requires employment opportunities and a skilled workforce to truly create economic value. In the 2020 census, 53% of young people aged 20 to 24 in China were attending school, while in India, approximately 40% of the population has an education level below elementary school. Another major difference between the two countries is the status of women. China promotes gender equality. As a Chinese woman, I think I have the right to see I can feel the equality when I step into the workplace, especially in the workforce with the labor force participation rate for women of nearly 30% in China. In contrast, the female employment in India is less than 10%. When it comes to the population dividend, education is fundamental because only through education can the population become a valuable human resource. According to a report by UNESCO, India also holds the unfortunate distinction of having the highest illiteracy rate in the world. Approximately 150 million people in India are still illiterate, accounting for around 10% of the population. In comparison, China's illiteracy rate is only 2.6%. So what I want to emphasize here is, over the past 20 years, it's just too simplistic to attribute China's economic rise solely to cheap labor. China's major system is a result of more than 20 years of concentrated investment by major global economies. And China's visible hand, what I mean is the government regulation, has been remarkably powerful, investing heavily for over 30 years or even longer. So don't even think about India replacing China. What I mean, even the Indian plus Southeast Asia plus Mexico combo, which some people in the US consider an alternative, can't replace China. Let me give you an example familiar to those who know the real economy. When a significant number of critical manufacturing processes concentrate in one area, the powerful integration arising from the clustering effect is hard to beat for other regions. Once a mutual supply chain is established, it gains a first-mover advantage, making it harder for latecomers to surpass it without accumulating more resources and conditions. This poses a significant challenge for India. Let me wrap it up with a statement from a German expert on whether India will replace China as a top manufacturing factory.
Das neue China?
Nein, auf gar keinen Fall. Das kann man nicht sagen. Also nur die Bevölkerungszahl an sich ist da nicht ausschlaggebend. Und Indien ist schon interessant, aber Indien ist auf gar keinen Fall ein Ersatz für China, sondern ein zusätzlicher Markt, den man vielleicht erschließen will, den man sich auch erstmal genauer anschauen muss. Viele Investoren aus Deutschland und Europa wollen die Abhängigkeit zu China verringern, suchen nach anderen Möglichkeiten in Asien und da bietet sich Indien eigentlich an, eben weil es große Potenziale hat, einen großen Wachstumsmarkt bietet. Aber Indien tickt komplett anders als China, das muss man schon wissen. Allein schon die Produktivität ist in Indien bei weitem nicht so hoch wie in China. Das ist gerade mal ein Bruchteil mit $4 Billionen im Jahr, Bruttoinlandsprodukt. Sind sie nur ein Bruchteil in China erwirtschaftet man bei dem Bruttoinlandsprodukt $20 Billionen im Jahr und das ist ein Vielfaches mehr.
Das ist ein großer Unterschied.
Let's move to the second question. Why is India becoming a target for foreign investment? Well, we find the fact that even though India has its fair share of obvious problems, foreign capital keeps flowing to it. First off, Chinese companies love investing in India, such as Xiaomi. They have already put 4.8 billion in cash from their pockets and fined Oppo nearly 4 billion. And it's not just Chinese companies facing this treatment. American companies supporting India has also been hit with the same stick. Amazon got slapped with a 172 million fine. Google had to fine 275 million. Whenever a company starts making big leaps in India, the government swamps in with unreasonable demands, fines or asset freezings. So why on earth is the United States still ramping up investment in India? Don't you feel it's very strange? Okay, I think one possible explanation is that since the Russia-Ukraine conflict, while the West has imposed sanctions on Russia's oil exports, India hasn't fully endorsed those sanctions. When it comes to the voting on matters related to these sanctions, India just has mostly chosen to abstain, and West hasn't forced India to take their side. As a result, many Indian refiners have started buying Russian oil from the traders in Dubai and then selling it to Europe and America at a profit. But they've silently accepted it. On July 3rd, the Indian Oil Corporation, India's largest buyer of Russian oil, started using the Chinese yuan to settle some of the oil transactions. They sell Russian oil to the West and settle in yuan. You could say that in the increasing fragmented world order, India has found itself a unique middleman position. Politically, they lean towards to the West, but in terms of the trade, they managed to find their interests between both sides. However, due to the Indian government's unreasonable behavior towards foreign companies, foreign investors see India as a beneficiary of American support rather than a self-reliant growth engine. This gives rise to an idea. The US supports Japan in the semiconductor industry and India in the low-end sector to divide the Chinese market. Furthermore, as we all know that India's low-cost advantage isn't something new. Since the Modi government strengthened its manufacturing policy in 2014, they've set a target of increasing the manufacturing sector's contribution to GDP to 25%. However, this target has yet to be achieved, reflecting international companies' doubts and concerns about investing in India. Essentially, today's entrepreneurs in the US and West are just as clueless about future and they're in a frenzy. All they can do is diversify their investments and not put all the eggs in one basket. If their existing business in China is still profitable, they will continue to making money. But at the same time, they will spend a ton of money on so-called alternative plans to hedge against any potential losses or conflict in the future. Buffett's and Apple's decision also hint at another concern, the fear of a real conflict in the Southeast region. Regardless of whether they want to engage in a conflict, at least these multinational capitals and companies will position themselves according to the ready-to-fight anytime scripts. These scripts will undoubtedly accelerate the outflow of foreign investment, orders, and industry chains and pose significant challenges to domestic employment. That's why the US is artificially creating more expensive global supply chains, ultimately passing on the burden to skyrocketing inflation. And inflation pressure will force the Federal Reserve to maintain a high interest rate, which will lead to the mounting pressure on US debt. The increasing pressure on US debt will promote other countries to accelerate their de-dollarization. This increasing pressure on US debt will promote other countries to accelerate their de-dollarization efforts, at least a hedge. So, we are witnessing a stunning and a comical saying: the China-fication equals de-dollarization. But the US can't be bothered with all that. In the short term, they want to control China's development. It's obvious that in the economic and trade area, China and the US are heading towards the economic Cold War. We all know that once a complete decoupling happens, everyone's in a rough ride. But we can't just sit idle. We have to prepare for decoupling. So step by step, even if it comes at a high economic cost, they're just pulling full steam ahead and put more money to India. For US, India represents most imaginative space to replace China as the next kick-ass primary manufacturing base. After all, Indians are affordable, they can speak English, and they have good relationship with Wall Street and US business communities. So the goal is to groom India as China's successor. And it's already a consensus among the US and Western countries. Actually, the US and West believe that they can continue to rely on the cheap labor from other regions worldwide to make money continually. I'm not very sure whether this concept or ideas can come true, but what I thought is everything changed right now, especially in the AI era. However, it's important to know that the investment landscape is complex, and there are multiple factors at play. While India may offer opportunities for foreign investors, it also has its own challenges. These challenges include bureaucratic hurdles, regulation complexities, and infrastructure deficiencies, and something unpredictable policy decisions. Sometimes unpredictable policy decisions. What I mentioned about that can create uncertainty for investors. Overall, the interest in investing in India can be attributed to a combination of factors, including its potential as manufacturing hub, its growing consumer market, the desire to diversify investment portfolios, geopolitical considerations, and aim to counterbalance China's influence. So, next question. How big is the economic outlook in India? And what about investment returns? According to the Indian Central Statistics Office data, over the past decades, India's average nominal GDP growth rate has been around 10.6%. The GDP deflator, also known as GDP contraction index, which reflects the general price level, stands at 5.1%, resulting in an actual average growth rate of 5.5%. On a global scale, in 2010, India ranked ninth in terms of total GDP. Since then, it has surpassed countries like Brazil, Italy, and France, and in the fourth quarter of 2021, it made history by surpassing the United Kingdom, become the world's fifth largest economy. Some organizations even predict that in the future, India might surpass Germany and Japan, becoming the third largest global economy by 2030. And guess what? Indian households are expected to become the biggest spenders among the G20 economies. Furthermore, according to the International Monetary Fund, India's GDP growth rate is projected to be 6.1% in 2023 and 60.8% in next year. That makes India one of the recognized fastest growing economies in the world. Well, from my perspective, India might be stronger than we think and is facing a historical opportunity. Whether it can seize this kind of opportunity depends on how well it tackles some domestic issues that are currently hindering its development. Low employment rates, weak infrastructure, and terrible business enrollment are like viruses infecting India's economic body. Take employment, for example. Data shows that between 2012 and 2022, India had 7 to 9 million job seekers every year. But the job market couldn't generate enough new positions to accommodate them. If these issues aren't addressed properly, the demographic dividend could become a demographic burden, I think. And speaking of employment challenges, India still holds the title of the country with the largest population of poor people in the world. So opportunities and challenges are dancing side by side here. The next move is up to India itself and see how it develops. According to data from Indian Central Statistics Office, India's average GDP growth rate of the past 10 years has been around 10.6%. Now, hold up, we got factor in the GDP deflator, which stands at 5.1%. Crunching the numbers, this gives us an actual average growth rate of 4.5%. Not too shabby, right? Okay, now that we've covered India's economic prospects, let's talk about investing in India. How do you do that? And what kind of returns can you expect? Alright, let's take a look at why Indian stocks have been on the rise recently. Starting from March, the Sensex 30 index, which represents the top 30 companies in India, In the past 3 years alone, the Sensex index went from a low point of 25,700 in 2020 to a whopping 64,300, hitting record highs in the Indian stock market. According to the data from the National Stock Exchange of India, foreign investors have been net buyers since March. In May, the net investment reached a whopping 438.3 billion Indian rupees, which is 4 times higher than the investment in April. As of June 16, the number reached a peak of 164 billion Indian rupees. Money is flowing, my friend. Especially after Prime Minister Modi's visit to the United States on June, American companies are showing a lot of interest in investing in India. They're just like, hey India, we're gonna pump some serious cash into you. And guess what? India is playing the middleman in the big global game. Many companies see India as a go-to place for shifting their supply chains. It's like Japan benefit from the big global game as a second choice. During Modi's visit to the US, he had meetings with big shots like Tim Cook from Apple, the CEO of Google, Tesla Elon Musk, and more very famous CEOs in US. After this, several companies announced their plans to invest in India. Let me break it down for you. Google, run by an Indian CEO, plans to invest $10 billion in India's digital fund and set up a global financial technology center in India. Amazon said that they're gonna pump an extra $15 billion into India by 2030 and making their total investment in India a whopping $26 billion. Elon Musk, he mentioned that possibility of some massive investment. So back in 2007, China's GDP per capita crossed the $3,000 mark. And even since then, their economy and domestic demand have been growing like crazy. There was a major turning point for them to become an economic powerhouse. Similarly, in 1972, Japan also experienced a rapid economic growth and increased domestic demand after surpassing $3,000 GDP per capita. Nowadays, apart from investment in the manufacturing sector, foreign investors are eyeing the domestic market in urban areas of India. India is witnessing a period of rising purchasing power among consumers outside urban regions. With increasing incomes, the middle class in India is expanding, and so is their consumption. The financial reports from the first quarter of 2023 confirm the strong performance of Indian companies, which has further fueled the rise in the Indian stock market. Take the example of Suzuki, the leading player in the Indian automobile market. Their revenue and profits hit record highs, and their stock price has surged by 17% since the end of March. Tata Motors has also seen a price hike of over 30%. India is undergoing a consumption upgrade, especially in everyday products and the smartphone industry. So it's clear that the sectors like pharma, financial blue, chip stocks, power, and consumer goods are the ones driving the maximum gains in India. Foreign investment in the Indian stock market revolves around 3 key factors. The first one is real estate and commercial banks benefiting from the demographic dividends, as we all know. The second one is power and TMT, technology, media, and telecommunications stocks. The third one is consumer goods, pharma, and IT outsourcing. Foreign investors follow a similar stock selection patterns as Warren Buffett did in Japan, focusing on monopolistic companies during economic growth. For instance, in January this year, Adani, the richest person in Asia, and his Adani Group held the largest market value in India. They were targeted by short-selling institutions from Europe and the US. The Adani Group practically monopolizes India's critical infrastructure, including the busiest shipping ports, largest power plants, coal mines, edible oil companies, farms, highways, and 8 airports. Last year, they made several acquisitions, becoming India's second largest cement producers and one of the largest television network companies. However, it's worth noting that Buffett invested in Japan mainly due to extremely low borrowing costs, which is not the case in India. Also, we must emphasize that India is quite protectionist when it comes to foreign companies. Almost all multinational corporations in India are at risk of facing unjust fines or asset freezes. This is biggest concern for international investors because the main reason to invest in India is to reduce geopolitical risks. That's why we believe it's a challenge for India to rely solely on manufacturing to become a major player. If the US is the boom market for tech stocks, then India is the boom market driven by domestic demand. So that's all the things about how to invest in India. If you want to go to invest in India, please think twice. See you next time, friends. If you want to invest in China, subscribe my channel and get a latest perspective of the equity research.